Okay, so the technical issue is gone now. So, all right, where were we? So we were at technical analysis, and obviously there are different kind of chart patterns and different types of charts. The most basic charts are the line chart, which only shows the closing price of the market after each period. And as you can see in this chart, that it's only a dot, and then you connect the dots and you can see the market trends. Then the markets and the traders optimize to bar charts, which shows during each period the closing price, the open price, and the price range during which the market went through. And most recently, the market, the investors adapted to candlestick charts, which were in fact invented by a Japanese rice trader in the 1600s, so a long time ago, but not for trading, obviously. At the time, he used it for his rice trades. But now we have developed platforms that are basically based on the candlestick patterns, and it is very easy for a visionary trader to follow the markets based on a candlestick, because at the first glance, when you look at the candlestick chart that do come in different colors, we have a set color for a bullish market, the market that is generally going up. We usually have colors such as blue, green, or white. So in this chart pattern over here on the left side, we have a black and white candlestick chart pattern. The white candles suggest that the market opened at the beginning of this candle, you see, and it went all the way to this. And during that period, it finally closed at a higher price than the opening price. And reversely is the bearish candle, which are presented in different colors such as red, purple, or in this chart's case, black, where the markets open at a specific price. During that specific time period, it goes through all these ranges, it goes to this high and comes down to this low, and then it closes at a lower price than the market opened. So this is a bearish candlestick, and we know that during that time period, the market generally went down. So we can use these candlesticks as indicators out the images that the market is, the trend, right? But we can also use the candles themselves as covered today. So basically, the basic candle shapes that are important that we're going to mix and match in our reversal indicators further on are these three. The first one that I want to focus on is called marubozu, which is obviously a Japanese vocabulary because, as I said, the candlesticks were invented by a Japanese rice trader, and marubozu in Japanese language means completely shaped. So the reason why it's completely shaped is because, as you can see, this, for example, bullish marubozu candlestick does not have any shadows coming out from the top and the bottom of the market. Do you understand what this means? What did that mean? That there is no shadow coming out of this candlestick market. What happened? Where did the price go? The price, basically, this candlestick shows us the story of the price range of the currency pair during that specific time period. And it says that the market opened at this price, and it went directly all the way up and didn't even test any other prices. So that's why we don't have the lower or upper shadows. It didn't even test a lower price. It just went strongly up, and it close at this price. So this is a very strong bullish indicator, okay, because the market is very confident. It is not testing any other prices. It's not even thinking of going down. So it's a very strong bullish market. And reversely is the bearish Marubozu, which the price starts at this specific price and shoots down without hesitation all the way down and then closes at the end at a lower price. So this is a very strong bearish market, right? So the next basic candlestick shape are the bullish and bearish spinning tops. So this is the exact opposite of the Marubozu, because you see how strong the market and confident the market was in the bullish Marubozu? In a bullish spinning top, the market is very indecisive because it opens at this price and then it goes all the way down and tests different prices and goes up, and then it closes at slightly higher price, right? So it is still bullish, but it is indicating that the investors and the traders are indecisive, are not as bullish as they were at the bullish Marubozu. They still don't know what's going to happen. They are fighting. The sentiment is kind of low and weak. Same with the bearish spinning top. And the reason why we call it the spinning top, because it actually looks like a spinning, do you know those toys that you spin around? So that's the reason why it's just a very visionary name for it. If you want, you can call it something else. I cannot come up with a different name, but that's what most traders call it by. And this one is the bearish spinning top, where the market starts at this price, it tests all the way up and down in decisiveness, and then it comes back up and closes at a slightly lower price. Then even more indecisive than the spinning tops are the doji candles. The doji candles basically have no body. And by the way, we call this candle, aside of the shadow, the body of the candle. So basically a candle consists of the body and the shadows, right? But the doji candlesticks over here, they don't even have a body, because the price is basically started at this location, at this price, the market. It tested all these prices and then came back and closed at the exact same price. So the shadows of the doji candle can be different. So, for example, in this doji candle, the shadow is very distributed evenly. But this one, the lower shadow is longer. This one has a very long legs both ways, so we call them the long-legged doji. And then we have the dragonfly and the gravestone, because this one looks like a Christian gravestone and this one looks like a dragonfly. So, for example, in this case, the market started at this price, tested all the lower prices, and came back all the way up and closed at the same price. So this is a very indecisive market. Okay, so now what are we going to do with these basic candles? We're going to mix and match. And all this comes from experience, because over and over again, traders have seen the same pattern going on the charts, and that's why we usually take the indications. Again, I'm going to say that these are not 100%. These are just indications that help us with our technical analysis, and we should not base all our technical analysis only on one type, for example, only on candlesticks. You always have to mix and match with other types of technical analysis. So let's go back to the charts before we get into the indicators. And this is kind of a review for those of you who attended our previous webinars, and for those of you who are new today. A chart can come in different time frames. We're selecting only 3 of them over here, but you can have your chart, you can set your chart on your Orbix platform on a 5-minute, on 30-minute, a 4-hour, 8-hour, 6-hour, daily, weekly, and monthly, and so on. And what does that mean? This number, the 30-minute or the 4-hour, means how much it took for each of these candles on the chart to be made. Okay? So this three that I'm showcasing over here are the same euro-dollar chart on the same day, but you see that they are completely different in the different time frames. Why? Because the 30-minute chart is a micro view of the market. Each of these candles took only 30 minutes to develop. So basically, if you zoom into a 4-hour chart, you get the 30-minute chart, and it shows the most recent sentiment of the market. And so for the 4-hour chart, it is a more macro view. Comparing to the 30-minute chart, each of these candles take 4 hours to develop. So for example, this candle by itself, it is a bullish candle, as you can see. This is consisted of all these bullish candles over here on the 30-minute chart, right? As you can see in the 30-minute chart, these are the development and the continuation of 1, 2, 3, 4. Well, it needs basically 4 candles, right? But over here, it's showed in only 1 candle. So depending on the type of the trader that you are, you want to make sure that you are on the right time frame. If you're a day trader, if you're a scalper, you want to be on a 30-minute chart, and these indication and chart pattern analysis applies exactly the same. But if you're more of a slower trader, you want to look at the 4-hour chart. And if you are a more longer trader like myself, you want to take a look at the daily chart, right? Or even the weekly chart. I definitely do suggest, though, that whatever type of a trader that you are, you take a look at all these charts just to get a feeling of the market sentiment, right, before trading on a daily chart or before trading on a 4-hour chart. Because you want to know, you want to level out, you want to test the waters and see what is going on in a micro view or in a macro view, right? Okay. So, any questions up until here? Everybody is in line with everything I said. We are getting more and more viewers. Welcome. New attendees. Great. So this is going to be very exciting. So, reversal patterns is the topic of today, but today is the reversal candlestick patterns. We covered it last week that a reversal pattern basically shows the market is going to, as the name suggests, turn back, right? So if it's a bullish reversal, that means that the market was going up. And a lot of traders, you may have seen, type in a Y if you have heard the saying that the trend is your friend. Thank you, Matt. Yes, he has heard it before. I'm sure a lot of you have as well. The market, the trend is your friend until you identify a reversal pattern. In this case today, we're going to identify a reversal candlestick pattern, and then the market basically turns back and becomes bullish. That is a bearish reversal pattern, right? And so today we're covering the bullish reversal candlestick patterns first, and then going to bearish reversal candlesticks. So a bullish reversal candlestick pattern, what it does is that it reverses a downtrend. Easy, right? And there are 4 identified candlestick patterns that they have beautiful names that we're going to cover today. Morning Star, Bullish Engulfing, Hammer, and Bullish Harami. Very intriguing, right? And all this basically is going to happen in this pause spot over here. And when you see that Morning Star, when you see that Bullish Engulfing, that Hammer, that Bullish Harami, you can expect the market to go up. Okay? All right. So let's see what the Morning Star mean. And Morning Star, you see, like, traders are not that boring, as you can see. They can come up with some cool names, right? A Morning Star, look at this. This is the pattern. It consists of a very long bearish candlestick. It doesn't necessarily have to be a Marubozu candle. It can have the shadows coming from the bottom and the top, but you have identified basically a downtrend, and then you see this. You see a doji candle. You see that the indecisiveness in the market sentiment. Okay? The traders in this time period were like, I don't know where to go. And then in the next period, you get a very long bullish candle. So that means that during this pause, during this indecisiveness period, the bulls, the people who were thinking that the market is going to go up, the bullish investors won the battle and the market reversed. And then you can expect more up moves in the market. The reason why it is called a morning star, because traders believe that it looks like Venus and Jupiter in the early morning, because it kind of looks like a star. All right, whatever works for you. If you want to call it the morning star, that's great. If not, just call it whatever you like. Just know that a bearish candle followed by a doji followed by a bullish candle is called it's a reversal bullish indicator. Okay? So, next one in line is the bullish engulfing. Okay. How many of you knows what engulfing means? Okay, Dan says eating. Yes, that's true. Eat. Yes, engulfing means completely swallowing and taking over something. Okay? And a bullish engulfing consists of after a downtrend, obviously. So you have a downtrend and it's coming all the way down, for example, over here. Then you have a very short candle, short bearish candle, followed by a very long and strong, oftentimes a bullish Marubozu that is so long that can completely swallow this little bearish candle over here. So the reason why this is a bullish reversal indicator is because it shows a change in the market sentiment. It shows that the bears over here were getting kind of weak, right? The candlesticks are weak. The price is not moving down that rapidly, okay? But then the bulls come and take the market, take the prices all the way up. And because this trend is your friend, right? After the strong wave of new trend that has started, you can expect the market to reverse and continue up. Okay? So this is the bullish engulfing when you see it. A downtrend, a weakening downtrend, a small, when the bearish candlesticks are getting smaller and smaller, and then suddenly you see a very, very big bullish candlestick. That is a bullish engulfing, and that is a bullish indicator. Okay? All right. Next in line, we have hammer. And the reason why it's called a hammer, I actually had to take some time and see what it was called a hammer. Then I took a look at the hammer that is nailing a nail and notice that it actually does look like a hammer, right? So it's like a hammer that is trying to hammer out a bottom on the chart. So let's see what happened in the market sentiment in this scenario. Okay, so the market is going down. We have a ton of bearish candles, right? And we don't care if the market was getting, but at this time, a lot of times, oftentimes you can expect a weakening bearish trend as well. But a hammer is the reason why it's a reversal indicator is because the market, you see, it has a very short body over here, but it has a very long lower shadow. What happened over here? The market was dumb, going down all the way, and suddenly it's not able to close lower. It tests all these prices over here with the shadow, and then it actually closes above the opening price in that time period. Okay, so that shows that the market is kind of no longer interested in being bearish anymore. Yeah, and it tested all the lower prices but was not able to close at a lower price, and it actually went up. That's why the shadow of hammer is so long. So that is why we can expect the bulls to have decided to win and have decided to go up. So another way of identifying a hammer, so take a look at this one. Like candles, you have to realize that even though I'm showing you these candles over here and they're perfectly in line with what I'm saying, candlesticks can oftentimes be slightly different, right? And take a look at these 3 candles over here for me. What does it resemble? It kind of resembles like a morning star, right? Because you have a very strong bearish candle, then you have an indecisive, well, you want to call it a doji, kind of a spinning top, but it is telling you indecisiveness. And the long shadow and the short body is showing you, is telling you that there is indecisiveness in the market. And it's followed by a longer bullish candle. So even if you didn't identify this hammer over here and got into a buy position right here, after you saw this follow-up, this following strong bullish candle, that can be your second confirmation that the market is going to reverse and is going to move up. So although if you wait for this candlestick to form, you're going to miss out on some pips, but it's obviously always better be safe than sorry. So you can wait up till here and wait for the markets to confirm the bullish reversal, and then get into the market over here and start making pips all the way up. Okay, so today we're not talking about stop and limits, because candlesticks, they don't help you with the stop and limit and the resistance levels, unlike the other chart patterns that we have covered before. These are merely a help, a support to your identification of other chart patterns that can help you confirm whatever you have identified before. So for example, if you have identified a double bottom, and this is the second bottom, for example, and then you see the hammer candlestick formation, that gives you the thumbs up that, oh yeah, so this double bottom pattern that I kind of identified on the chart is real because of this hammer. So you have the double confirmation, you can get into the market, and then choose your stop and limit based on the chart pattern or the Fibonacci or whatever that you use to basically set it for your trade. Okay? So that's for the hammer. And next we have the Bullish Harami. Alright, so there is another Japanese word here for you. Harami is an ancient Japanese word that means the belly of a pregnant woman. The reason why I know this, people, is because I did live in Japan for 7 years. So if you have any other Japanese questions, don't hesitate to ask me, okay? All right, so a Bullish Harami is basically a very strong bearish candlestick followed by a small bullish candle. It's not a very strong reversal indicator because, as we said, you want it to be followed up by another bullish candle. I mean, I know that a lot of traders, the reason why this exists is because a lot of traders do rely only on this. They see a bearish candle and then they see that the market actually is moving up, so they think that the prices are changing. But the best scenario for using a Bullish Harami is definitely to have other chart patterns there to support your identification, because by itself it's not a very strong reversal indicator, although it is very easy to remember because it does look like a pregnant woman, like you see the long bearish you want to call body and the baby in the belly, so the Bullish Harami. All right, okay. So I'm not going to spend more time on the bullish ones because we have more bearish reversal candlesticks and not much time. The bearish reversal, as the name suggests, is the opposite of a bullish reversal, right? And we are looking to identify that pause in the market in the form of the candlestick patterns and look for the market to go down this time. So during an uptrend, we see an evening star, a shooting star, a hanging man, a bearish engulfing, or a bearish harami, and then we could put it in our analysis that the market may reverse. Okay, so let's get started with the bearish reversals. The drum rolls, and the first one is the evening star. Doesn't it resemble the morning star that we had for bullish? It's the exact same thing. It's the exact opposite, and the reasoning behind it is the exact same. You have a strong bullish candle followed by indecisive doji or a spinning top or anything that shows you indecisiveness in the market, followed by a strong bearish candlestick that signals that the market, the bears have won the race or the battle, and the market is going to reverse. And we could expect the downtrend to come up next. Okay? All right. Do you have any questions up until here? Because I feel like I've been talking the whole time. Tap in the yes that you're okay with all the bullish reversals that we covered before. Thank you, Sam. Yes, you're getting it. Ronnie, thank you. Sarah, thank you. Thank you so much for all the encouraging comments. So the evening star was not that big of a deal because it's exactly the opposite of the morning star. Next one is the shooting star, which is very similar to the evening star. It's just a different way of saying it. You obviously do not have to memorize all this, but you do want to basically, when you, the reason why it's called a shooting star is because this is, again, something that I came up with. Hopefully that's the correct one. You have some, you know, bullish, bright stars over here, and then you have a doji candle with a very long upper shadow and a small body that looks kind of like a shooting star. Okay, and then you have a continuation of bearish candle signaling that the market was indecisive. Once again, I'm going to repeat myself. What happened here? The market was going up in confidence. Bam, 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 bam. It's going up. And then when it gets to this price, that probably is, for example, it is a key resistance level, right? So this level, the market cannot break above it. It teases above it. It tests all these prices with the shadow. But later, what happens? It actually closes below the opening price, right? And therefore, you can expect that the market sentiment is going to change, and we are going to expect a downtrend in the market. Okay? Next, we have the hanging man, which looks a lot like the shooting star. But what happened here? What is the difference over here? The hanging man, the shadow, instead of being up, the shadow of the hanging man is down. So obviously, this is a weaker reversal indication because with a shooting star, the upper shadow, it shows that the market did try to go up, but it wasn't able to. Here, a hanging man is kind of hammering out the top, but I personally don't use a hanging man alone as a bearish reversal. I usually wait for the next bearish confirmation after it, and then I would enter a bearish position on my platform. But again, I've thought about it, why it's called a hanging man, and this is the best that I could come up with. That, I don't know, somebody must have been doing some naughty stuff in the household, and the lady in the house decided to hang the man, and with his legs just dropping over here. So this is what I came up with. You can, if you have any other ideas why this is called a hanging man, you can just send us an email afterwards. You can type it over here if you have something on top of your mind. But the hanging man doesn't hang in there any long, and it drops. Therefore, in heck, the reversal, the bearish reversal indication. All right, we're moving smoothly, no questions up to here. And we are going to move on to the next bearish reversal candlestick pattern, which is the bearish engulfing. Remember the bullish engulfing? This is the exact opposite. What happened over here? The market was going up, bum, bum, bum. Then the market sentiment got weaker. We have a shorter bullish body for this candlestick over here. The market is not shooting all the way up. It's a very small candlestick. It is still bullish. But then the next one is a very strong and long bearish candle. It's long enough to eat up, to swallow, to engulf that small bullish candle before it. And therefore, we know that the bears have won the battle over here, and we can expect the market to reverse and for the trend to be bearish and to be down after this. All right, next one, we're moving smoothly, is the Bearish Harami. Okay, we do have a quiz over here. What do you remember? We just covered it. What does Harami mean in Japanese? I'm going to give you some time. And do not cheat if you have your internet right next to you. Don't cheat. Harami. Correct, Takai. It means pregnant. Yes, it means a pregnant lady. So we had the bullish Harami before, that we basically imagined the first candle to be bearish, but here is the bearish Harami. The first candle that is long is bullish, and then the next one is a small bearish one that is continued by a next bearish candle, signaling that the market trend has changed. Just like a bullish Harami, a bearish Harami is not that strong of an indication, but still you can use it when you mix and match with other reversal patterns. Okay? All right, so that's it actually. We were very smooth and in time today with the reversal candlestick patterns. Here is a summary. If you want to take a snap flash or you want to make a print out of this, feel free to do it. You can snip it if you're a PC person. If you're a Mac guy, I don't know how to do it. But this is a summary of the bullish reversals. We had the morning star, a strong bearish candle followed by indecisiveness in the market, followed by a bullish, very strong bullish candlestick. Then we had the bullish engulfing, a small bearish candlestick followed by a very strong engulfing candle, bullish candle, right? And then we have the hammer that hammers out a bearish market. It kind of does look like the morning star, but the hammering out, it's like it basically, especially if this happens oftentimes during the key support level, and it tests this key support level, it is unable to break below it, and it opens above it, and therefore the indication for a reversal, a bullish reversal. And then we have the bullish Harami. It is not as strong as any of these three, but when you identify other reversal chart patterns, this can come to help if you need like one last confirmation for your reversal identification. And similarly, the summary for the bearish reversals, we have the evening star, a very strong bullish candlestick, followed by indecisiveness in the market presented by a doji candle or a spinning top, followed by a very strong bearish candlestick, in heck indicating that the market has reversed and we could expect the market to move down. Then we have the shooting star, which is the opposite of what was it that we had? The hammer, right? It is the opposite of the hammer, right? It oftentimes happens at a key resistance level. The market is going up. Then you see the indecisiveness by the long, higher upper shadow of the market. Then the market closes below the opening price, and heck, you can expect the market trend to reverse and expect more down moves. Then you have the hanging man, very similar to the shooting star, except that the shadow is a lower shadow. It kind of tops out the uptrend, and after, usually you want to make sure that you have a next bearish candle after the hanging man, and then you can expect the market to move down. We had the bearish engulfing, a small bullish candle followed by a long, big, strong bearish candle. Expect the market to go down. Bearish Harami, the weakest bearish reversal indicator of them all, but if you mix and match with other patterns, it's still good. Okay, that's it for the bearish reversal and the bullish reversal candlestick patterns. If you have any questions, type in now today. Questions, just type it in, and then we can actually go and identify some markets, some patterns on the market. Okay, so John is asking, so which indication is stronger, the shooting star or the hanging man? As I said, the shooting star is stronger than hanging man, but the bearish Harami is weaker than the hanging man. Okay, so that's how the indication strength goes. Do we have any other questions over here? Thank you so much for everybody who is actually asking questions. And you can obviously, if you cannot think of any questions right now, you can definitely email us at info@orbex.com or email me personally at Kiana@investdiva.com, and we will definitely make sure to answer your questions. We do have a couple of minutes, so I would like to take a look at, hold on one second. Let's take a look at the charts today and see if we can identify any patterns. Oh, look at this. This is actually before, right? Let me, this just came into what do you think this is? Look at this one. Just caught my eye over here. This is the shooting star. You see the market was going up, and we have this short body of a bullish shooting star, and followed by a very strong bearish candlestick, and thus a bearish reversal. Let's see what's going on in the markets right now. Right now, we're just having all these. This is the dollar Swissy market, and we are having an off day today because tomorrow is Thanksgiving Day here in the U.S., so the dollar pairs are dropping, especially because of the GDP results today. So we don't have any reversal per se on dollar Swissy. Let's see if we have any reversals on dollar CAD. The market is kind of indecisive over here. It is consolidating. This is a spinning top, but not specifically an indication of the market. So this is, you can see a series of spinning tops and small short-bodied candles over here. And, well, I have identified this level over here. This is the 112 area, and this is a key resistance level, and the market is basically consolidating and basically very indecisive as to what is going to happen. But you can see that the market is kind of bearish. It did test a little bit above this key resistance level, but now it's going down. So together with the candle, with the short candlestick and the resistance level that we have identified, we can expect actually a bearish reversal up over here, right? Unless the market confirms and moves up, which is kind of unlikely because we have the spinning top and we have the resistance and the tees, the bearish tees around the market. So that is how you can use the candlesticks with your other chart pattern analysis and have successful trading. Okay, so everybody, thank you so much. It is 1 p.m. here in the U.S. It's going to be Thanksgiving. I'm very excited. If you're in the U.S., happy Thanksgiving. If not, trade responsibly. Do not trade the dollar purse tomorrow. Actually, no, you could. You know what? You could, because the markets are still going to be open, but you don't have to worry about the U.S. economy tomorrow. At least you can, if you're, for example, trading euro dollar tomorrow, you can only focus on the euro economy, what's going on in euro, because the U.S. dollar is not going to be pushing the currency pairs in any direction, but the counterparts are actually going to be in charge. Okay, so I don't see any other questions. Thank you so much for attending, and have a great weekend. I'll see you hopefully in our next webinar.